Is big oil back in vogue? Next on the Energy News Beat Stand Up.
Why advertisers are returning to big oil despite net zero pledges. This falls on the heels of Trump week at the UN. Advertising firms are following banks and retreating from net zero comments, prioritizing business with bank oils. Financial realities and AI disruption are pushing agencies to secure reliable, high-paying clients in the energy sector. Michael, this also ties into several of my articles that I've been writing about. Investors are rolling away from renewable energy to oil and gas because what matters to investors? Returns.
Yeah,
who's been given billions of dollars of returns? Advertisers want returns. And this was an outstanding story by Irina Slav on oilprice.com. She laid it out. The Financial Times reported this week that advertisers are going away from bankers, rephrasing their decarbonization messaging on websites and rediscovering the energy industry as a client. You can't buy this kind of entertainment, Michael.
Yeah, and this actually, a lot of this stuff actually comes from the Financial Times. They cited a climate campaign organization called Clean Creatives, showing that advertising and PR agencies have actually boosted the number of contracts within the energy industry with clients over the past 12 months. So everyone's fallen back in love. I mean, we've seen it here. We've never been busier on the Energy News Beat side, guys. We can definitely help with all this too. If you guys are interested, needing help getting your story out, Stu does a great job of that on his podcast. But it again, Stu, goes to show you, like you were talking about, and like what we've been saying, at some point the market corrects itself. The beautiful part about working in a free market is that it'll eventually correct itself. Yeah, there may be some up, downs. Nothing's ever a perfect straight line, but the market always wins. And you're seeing it exactly right here. If Clean Creatives is coming out and saying, well, everyone's diving back into advertising for oil and gas, well, that's probably a signal.
Speaking of that, it's a good thing to contact either me or you and become a sponsor of the show because we have such fantastic reach. Speaking of fantastic reach, let's go to this next story. Chinese lithium battery took down South Korean intelligence agency, and Texas has 1,200 of these things installed. For the green energy fans, there's a wake-up call for security concerns. Michael, this was really a big incident. This was like a small data center starting incident raised arms in South Korea's National Information Resources Management Agency in Daejeon on September 26, crippling dozens of government systems. And there are rumors out there that it was remotely heated up by cyber attack, but that's not confirmed. I have to put that it's not confirmed in there. But we have 1,200 of these silly batteries that are in here. It is a CATL's rechargeable Lion system that are in big battery systems in Texas. And this is absolutely so. Any data center that has 5 gigawatts of storage capacity in this one project can be taken down remotely by these things. You know, you got to really double check your equipment with this thing. So when you're doing a project, make sure you got good ideas and good information on your equipment that you're putting in. I do want to stress this one thing. The South Korean fire, while not directly linked to the Chinese it serves as a cautionary tale. You and I talked about all of the problems that the Chinese have been putting in over the years. We even talked about when the balloon was going over and how it possibly connected to the 492 major grid interconnects that are susceptible to being remotely shut down. I'm not saying the grid's going to be shut down tomorrow, but have a plan. If you're a CEO of a company, understand your grid and your business needs for energy. If you don't know, call me and let's get you hooked up with some folks and get you set up with some backup power or something, whatever you need, but make sure you have a plan.
Yeah, absolutely. All right. I don't have much. I want to really talk about this next one here.
All right. Dallas Fed survey reveals unrest in America's shale patch. Michael, this was a big one, especially because this came from David Blackman's Substack, and we recommend subscribing to him. However, this brings up the biggest point, drill, baby, drill, and then compared to what's really going on in the oil and gas industry. And this Friday, I have David Blackman and Josh Young. We are going to talk about the state of the oil markets coming up. We're going to be live on X, YouTube, and LinkedIn. In his remarks this week, President Donald Trump reminded the UN General Assembly, we have an expression, drill, baby, drill, that's what we're doing. But according to 80%, this is out of the David Blackman article, according to 80% of the dozens of shale oil executives who responded to the third quarter oil and gas companies by the Dallas branch of the Federal Reserve, that's all about to come to an end, thanks in large part to the president's focus on cutting oil prices and means of controlling inflation. The uncertainty from the administration policies had put a damper on investment in the oil patch, one executive said. Another warns that drilling is about to disappear. Executives, oilfield service companies aired similar concerns, pointing to recent layoff announcements as a symptom of the current market environment. A vibrant oilfield services sector is critical if and when U.S. needs to ramp up production, one says. This is a big deal. There's a lot in this article.
First off, I love the Dallas Energy Fed survey because a lot of this is done, and not a lot of it. All of it is done under the guise of anonymity. So part of that is people have a little bit more free reign. They feel like they can go at it a little bit more. But truthfully, I think you get a much better response from people when they're able to give you comments under the guise of anonymity, because obviously the last thing you want is any fallout from your investors, from politically. This is unbelievable, Stu. Here's this quote by one upstream executive. I usually just go straight to the quotes. I do tend to look at some of the statistics, but I always look at the comments. Listen to this, Stu. Basically, the business has been gutted by political hostility and economic ignorance. The previous administration vilified the industry, buried in regulation, and cheered the flight of capital under the ESG banner. And now the current administration is finishing the job. I mean, going hard. Here's one more. This is another one. I mean, this is a really, really, really long one. And to finish that quote, he basically says, and this same executive says, guided by the U.S. Department of Energy that tells them what they want to hear instead of hard facts. Ooh, that's a pointed shot across the bow. Can I be honest? I don't necessarily disagree with that comment, though, but because they operate with little understanding of shale economics. I disagree with that. I think Chris Secretary Wright understands shale economics, but he's caught between a rock and a hard place. He, on his hand, his boss wants $40 oil, and on the other hand, his friends want $70 oil. You're going to be in this interesting scenario. You're going to be in this interesting chasm. Instead of supporting domestic production, they've effectively aligned with OPEC using supply tactics to push prices below economic thresholds, need capping American producers in the process. The collapse of capital availability has fueled consolidations by majors, pushing out independents and entrepreneurs who wants to find the shale revolution. In their place, a handful of giants now dominate, but at the cost of enormous job loss and the destruction of the innovative, risk-taking culture that made the U.S. shale industry great. Another quote says, commodity pricing seems impossible to predict, with daily market swings over 5% up and down being normal for both natural gas and crude. We sell to spot pricing, so our near-term financial performance is unpredictable. There are far too many levers that are being moved at the same time in everybody's models, zooming out at the macro level. It's no wonder the market is so volatile. There's some other interesting stuff. I mean, there's one guy that talks about California permitting issues, but that's, one. I love this. We are very confused as to the effect of the Saudi increases due to the increase in storages. Crude prices are firm. What gives? The service companies go absolutely even harder at the administration, basically. And this one quote says, the White House doesn't know what they're doing. Tariffs are increasing our supply costs. I mean, they're going hard in the paint, Stu. And to be honest, I can't necessarily blame them, because the industry has been put under a huge swing. This goes back to a comment I made multiple weeks ago, where it's really crazy why people in the oil and gas, if you just think about it logically, if you think about looking out for your own, we always say, President Modi, we love him because he's looking out for the Indian people. Well, if you take that same approach to yourself and you look out for yourself, it's crazy that people in the oil and gas business vote Republican, because especially this administration is doing everything they can to actually drive this industry into a worse economic financials. And the fact that they vote conservative shows that they're actually principled people. They put other people's and the country's needs ahead of theirs. It's really unbelievable. This goes hard in the paint. I highly, highly recommend everybody reading this, Stu. But I was getting a kick out of this, Stu. This was wild.
It is. And there's a couple big things coming around the corner on pricing on this. My next article I'll talk about here in a sec says, U.S. shale costs to soar to $95 in some basins kind of plays into this. It is a cyclical business. And when you said that there are a variety of issues, this is another quote, affecting our businesses. One responds, first, excess in the global oil market is restraining oil prices near term. That is a false narrative because there's really not an excess in the global market coming up because there is another OPEC increase that is being announced, but there is only one country that really has any spare excess capacity. In fact, we have 1 million barrels of oil a day of refining capacity that have come offline from Russia. So when you look at the downstream and the oil markets, it is a whole different animal.
Yeah, I think it is. But I think what you're seeing here, in my opinion, is the frustration of the oil and gas industry screaming to get some help from the administration. I mean, it's truly, they extended the olive branch and helped elect this guy. And now all of a sudden, they even got one of their own, theoretically, Secretary Wright, into the position of whispering in the ear of the president. Yet everything they do is anti-oil and gas. It really is crazy.
But I agree and I disagree because I think
we can criticize President Trump. It's okay. He's not going to jump out of the screen and strangle you.
I'm not criticizing President Trump because President Trump's drill baby drill is not happening. I'm not trying to even say that. I'm saying he does not understand the oil market. And when he does not understand that you can sit there and say drill baby drill, well, not so much.
Now, what's funny is we'll see in my segment, rig count, frac count spread are both up. So maybe something is going on, but that has more to do with pricing. My last point here, the big defining theme from the Dallas Energy Ed survey is noise and chaos. There is no stability. If at least when the Democrats are in charge, we know things are going to suck, and it's just a level of suckness that we agree to. Here, we're up, down, left, right, and I think that's what the people are screaming about is let's just get some stability. Even if the stability is lower extreme prices, this person who made this quote is absolutely correct. These 5% daily market swings up and down and no business will be able to survive, no matter what industry you're in.
Okay, it's a global oil market not controlled by President Trump or the secretary. The global market is something that is the pricing matrices is something you can't control. So let me go to this next story. The U.S. shale cost. And so let me back up to that. You can't just sit there and blame that on President Trump. He doesn't understand the global market. And that comment also doesn't understand the market when it is a global oil porous market. I mean, we can sit there and say there are so many wrong things that are being priced in. Let's take Iran, Iraq, and California. Iraq is putting in another pipeline to Iran to help them ship more crude out. And I was going to run another story that you and I were going to talk about on that was including in this so that we could get more oil to California on that. How does all that play into this? Because all of it is a problem that is a global problem. It's not just the administration's problems. He's trying to clean up 4 to 5 years of horrible problems.
Yeah. And I don't think these comments are saying it's the administration's or the secretary's fault for oil price. I think everybody knows oil prices, the global market. But then what you need to do is everything else that runs and also affects the oil and gas business that we can control. There would be nice to be some stability there. I mean, these tariffs, I'm a fan of, but they were rolled out horribly. One day they were here, one day they were here, left, right, up, down. Maybe, yeah. Again,
and they're working.
If there was a clear tariff, and I'm not saying they're not working, and I'm actually a fan of them. But the problem is if you don't have a clear policy, and one day it's 10%, the next day it's 15. There's a leak over in the New York Times that says it's going to be 20. If China doesn't, sneeze with their right hand, now it's going to be 35. The uncertainty on where things are going is I think what this is getting at, and that's where I definitely agree with these comments.
Well, I see it as negotiation. You see it as calamity. Let's go to the next story. U.S. shale costs to soar to 95 per barrel within a decade. And I had fun writing this little bit. U.S. shale industry, a cornerstone of the global energy supply, is facing a pivotal. This kind of goes along the whole thing. The Dallas Fed survey caused me to write this article. This forecast signals the end of a relatively low-cost shale extraction driven by the depleting high-quality reserves. This follows also along my good interview with Trisha Curtis over there at Petro Nerds, and we talked about the Permian, hit peak Permian yet, where we've not, but costs are going to rise. And Michael, I have a chart in here that is Permian Delaware current break even $55 to $64. Costs could rise 20 to 30% as tier one inventory deplete, pushing toward the 75 to 85, and regulations and flaring are really adding pressure. Take a look at the Midland area. There's other ones. So I broke it down by basin, by what is really causing some of their heartaches. And I have a feeling these are some of the reasons that Dallas Fed survey had some of those comments in there.
Well, absolutely, because I think people are seeing this, and I think really what this article is talking about is really the exhaustion of what are called kind of tier one drilling locations, which are the creme de la creme, the best locations where you can lay a well, you drill a well, you know exactly what it's going to get because you've got two wells on the other side. You're in a shale play, depletion, you figured it out, you know what your gun barrel is, all the stuff that, oil and gas engineers and geologists spend years trying to figure out. That's what a tier one location is. But then you have tier two, tier three, tier four. I mean, it's the same way in real estate. You've got your creme de la creme, you've got a little bit worse. Then you've got your stuff that's not that great, really far out. I think it's called like class A, class B, class C. You get down to tier 3, tier 4, you're a class Z sort of material. I mean, you might not even have air conditioning. You've got rats running through the facility. So I think, and yes, what is happening, and I think what's driving, I think one of the reasons why prices haven't absolutely plummeted to $40 is the fact that as we were coming into this new administration, we had already exhausted a lot of those tier ones because those are getting drilled. Everyone drills tier one regardless of what prices are, really, because it's because you can make the most amount of money on them. Nobody, maybe in $120 oil, you might save some of your tier one in the bank and start drilling some lower end. But that's to say that you're a company that actually has enough inventory that's split out between tier one and tier two. There's a lot of these independent companies, Stu, that they just have their locations. I mean, they don't necessarily, their acreage position sits somewhere, and they don't necessarily have the ability to say, well, we've got a little bit in this tier one area, we've got some down over here in tier two, so we can kind of jimmy around with the schedule. And I think what's interesting here is that the shift from tier one to tier two, this is according to our good friends Blackstone and Veris, they estimate that the shift alone could add $15 to $25 per barrel in terms of marginal cost by the 2030s relative to this. And we just saw, as you said, Stu, in the Dallas Fed Energy Survey, that I think the industry is echoing this. So you're right. It's a cyclical business. Prices will begin to shift back upwards. I think the question is, how low do we get on the production? How much does production drop? And you mentioned that great interview you had with Petro Nerds CEO. I think it's extremely interesting to think about, and it's going to be very interesting to sort of see where these wires cross.
Oh, yeah. I'll tell you what, it's kind of entertaining out there. So it is cyclical, and my oil bull that I'm about ready to go feed in the backyard, he's getting kind of hungry. I'm still an oil bull because I think the prices are going to come back as long as we don't see World War III, and as long as we can keep Lindsey Graham's mouth shut, we may be able to survive it. So
I'm just getting a phone call here.
Yeah.
Well, hello, Michael Tanner. Oh, Goldman Sachs. You're hiring Stu as their new global oil price analyst. Well, yes, he's bullish, so we're good. All right, we'll send the paperwork. Thanks. Looks like you got yourself a new job, Stu. Oil bull, we love it.
All right, but I never gave a date.
Save yourself. All right, let's jump over and quickly cover what's going on in oil and gas pricing. But before we do that, guys, let's quickly pay the bills. As always, guys, the news and analysis you just heard is brought to you by world's greatest website, www.energynewsbeat.com. Stu and the team do a tremendous job making sure that website stays up to speed, everything you need to know to be at the tip of the spear when it comes to the energy and the oil and gas business. Go ahead and hit the links in the description below for all links to the timestamps, links to the articles, and specifically subscribe to the show on YouTube, subscribe to the show on Apple iTunes, give us a follow there, subscribe to our show on Spotify, please leave comments there, and subscribe to our Substack, theenergynewsbeat.substack.com. That's probably the best place to support the show. Stu does a great job of releasing, 2 to 3 articles a week that really encompass the big themes that are going on. We also drop all of our podcasts there, which give a little bit of a breakdown. We just had a great podcast, so I highly recommend everybody subscribe to our Substack, theenergynewsbeat.substack.com. We'd also like to thank friends of the show, Reese Energy Consulting, for supporting the show, guys. Reese Energy Consulting is the foremost midstream expert, guys. If you at all are dealing with issues in the midstream space, whether you're an upstream company and need help with first purchaser's contract or renegotiating your gas contracts or figuring out where you're going to tie in your next pad because you've got multiple different options and you're trying to break it all down, Reese Energy Consulting can help. If you're in the midstream space and need an extra pair of hands, need some permitting or regulation help, or need some red team analysis on a final investment decision, guys, they have the team that can help you. Check out ReeseEnergyConsulting.com. They have clients everywhere and all throughout the country, from 2 people in a garage all the way up to the largestly publicly traded companies in the world. So if you're wondering, are you a good fit for them? The answer is yes. ReeseEnergyConsulting.com. And finally, guys, invest in oil.energynewsbeat.com. We are coming up on the end of the year, and I promise you guys, you do not want to be paying money to Uncle Sam. You want to keep as much money in your pocket. You want to diversify your portfolio a little bit, and you want to get some dividends. You can do that by investing in oil and gas. Check out investinoil.energynewsbeat.com. Fill out our portfolio survey and our tax calculator. And guess what, you guys are going to get and get a nice ebook that tells you here's what you should look for when you invest in oil and gas, and also figure out what your tax burden is and figure out how much you might save relative to your tax burden if you did invest in oil and gas, guys. We practice what we preach here, guys. We do this stuff ourselves. Invest in oil.energynewsbeat.com. Don't give your money to Uncle Sam. Figure out and find out if oil and gas investing is for you. Depending on if you qualify, we will, again, send you all that information, and we may or may not point you in the right direction. Again, invest in oil.energynewsbeat.com. Oil prices on Friday, Stu, was kind of all over the place. Speaking about the little the Dallas Fed survey article, prices started around $65, spiked all the way up over $66 to about $66.30, settled at about $65.27. Looks to open here, as the market will open here as we record this on Saturday, somewhere around that $65.19 mark. But really, the interesting part was there were 2 stories that are kind of driving the narrative here. We saw this on Friday, Stu. OPEC Plus poised to slip further below oil output target. This is from our good friends over there at Reuters. OPEC Plus has delivered about 3/4 of the extra oil output it targeted since the group started the original production heights back in April, and that level may fall closer to half later in the year as producers hit capacity limits, according to sources and analysts close with the international oil companies and the data that they've been releasing. So, Stu, you've been preaching about this for years now, and now you're a little bit vindicated because this is, all of this increases that they're doing. They're able to do some of it, but that spare capacity isn't just there. It's pretty unbelievable, and there are some curbs taking place because of oil production, but these next output hikes may only deliver half of what was promised, which is partly what drove oil prices up so heavily on Friday. What are your insights to this, Stu? Because you've been on this for a while now.
The spare capacity, especially when you take a look at spare capacity in Iraq is barely hanging on, and they've got so much natural gas, they have to now start importing LNG. Iran is barely hanging on, and then you have Russia that has just been bombed their refinery capacity. So you look at OPEC Plus there's one of the countries does have a decent amount of spare capacity. But when you look at Saudi Arabia, they've got some spare capacity. The mathing ain't mathing up. And so it's just that as long as demand is going to be there in India and in China, we are going to see $70 oil. I mean, I'm sorry, I hate to ruin everybody's day, but we will get back there.
I mean, no, we will. It's a cyclical business, and I think the funny part is so that article and that report drops on Friday. Then about 2 hours ago, okay, exclusive, OPEC Plus plans another oil output hike in November, according to sources. So you got two sides of the coin. You got the angel and the devil on the shoulder, both giving opposite stories about what's going to happen. I mean, it's unbelievable. On Friday, it leaks that, hey, guess what? We don't actually have any spare capacity. And now they're trying to throw the narrative back the other way. We're saying, but wait a second, we're going to add more barrels to the market. And what they're claiming here is that OPEC Plus is going to approve another oil production increase of about 137,000 barrels per day at its meeting next Sunday, so a week from today, as they've seen these rising oil prices encourage them to, quote unquote, steal back market share. Again, I don't think it has anything to do with market share. I think it has more to do with they took all these cuts, and now they're trying to say we want those barrels back on the market, but now they're realizing they don't have the barrels. And so how do they control the narrative? Again, Stu, as you mentioned in our Dallas Fed survey segment, they don't quite have, and OPEC doesn't quite have the power they once did. And I think it's more about power than I think it is market share.
I agree. In fact, there is a real question whether or not they're even a cartel anymore or have the capacity to be a cartel.
Yeah, I mean, they could attempt to corral people, but again, at the end of the people only do what's in their best interest. So I think it's really interesting. So Friday, no more spare capacity. It's over. They can't even hit their current targets. Sunday. Oh, no, wait a second. We're going to add more barrels to the market. So the answer is always somewhere in the middle when we have this. And finally, guys, Occidental is in talks to sell OxyChem unit, which is their chemicals unit, for at least $10 billion, according to the Financial Times. All we basically heard was that Occidental is negotiating the sale of its chemical division known as OxyChem in a transaction that may or may not be valued somewhere at around $10 billion. They claim at minimum $10 billion. What does OxyChem do? They quote, they're a leader in essential chemistry. They have multiple different product families, including chloralkaline, vinyl, chlorinated organics, and multiple other essential chemicals like potassium chloride, sodium silicates, and have really been a stable part of their business for the last really 100 years as it comes down. To give you guys an idea, OxyChem did about 231 million of net income relative to the rest of the business. So you kind of extrapolate 230 million out, you get to about $1 billion a year of net income. And then that, you multiply that, what do chemical companies trade at? 7 to 12 to 1 times net earnings. So you're looking at, that's where that 10 billion number comes from. And they're going to want the 12 to 1, not necessarily the 7 to 1. So I think that's where a lot of those numbers are coming from. It's going to be interesting who the buyer pool is, Stu. Does this go to private equity? Does it go public? They didn't really list who a potential buyer could be. I have a feeling Dow Chemical will just swoop in and buy them. I mean, if you're asking me who's going to take this on, it's probably going to be Dow Chemical. They're one of the few chemical companies that have an ability to handle this type. It could be maybe DuPont. I think there's a couple different companies that might be in play here, but my guess is it's going to be one of the big conglomerates because this $10 billion is not going to come cheap. Obviously, what Oxy's trying to do is they're trying to use this to pay down debt that they've acquired over the last 15 years. Good old Warren Buffett would like some of his cash back at some point instead of just swapping them for warrants. So I think it'll be fascinating to see. But Oxy in negotiations to sell OxyChem division. It was a busy week for us last week, Stu, and now it's one of my favorite segments where you get to scare us. What are you worried about coming up this week?
No, I'm not. The good guys are still in charge, at least till the midterm. So I am really not worried about it. As long as we get Venezuela, don't go to war with them and just kind of get them run out of town, get rid of Dominion voting machines, I think we're going to be in great shape.
What's with this whole meeting of the generals? What's going on there?
I think there's about 4 or 5 different things going on. And I quite honestly think it is absolutely wonderful for Pete to bring in the generals. There are things that you would hear from the QAnon folks. There are things that you would hear from the other folks. And I think Pete telling his generals to have them lift their hand and say, we will no longer be woke, and then fire any of the woke generals is absolutely what is needed.
Oh, interesting. So that's what they're doing. They're swearing woke loyalty oaths.
I think that's part of it, but you have China. I wrote the article last week on China. China is got fiscal collapse written on it. They've always gone to war whenever they've had a fiscal collapse. They've been around a lot longer than we have, but the pattern is there. Then you have Russia. Then you have Zelensky duct taping drones and throwing them over the border in Poland to try to get Poland to go into war. There's a lot going on around the world, and having secure communications is very important when you look at your generals. I think it's great.
No, I completely agree. I'm just giving you a hard time. I do love the fact that we break news that Zelensky's trying to do false flag events. So
Sorry, I think it's funny.
Oh, guys, well, that's a great way to wrap up the show. We appreciate you guys starting out your week with us. As always, Energy News Beat will stay on top of everything. But for Stuart Turley, I'm Michael Tanner. We're going to let you get back to work. Start your week. We'll see you guys next time, guys. Energy News Beat Daily Stand Up. We're out.